Hello and welcome back to another stock analysis on Stock Market Palantir. Make sure to subscribe and let us know your thoughts in the comments. Now, let's hear from our analysts.
We are jumping directly into what has to be the most compelling and frankly catastrophic divergence we've seen in the microcap space in a while. CHOW Cloud International Holdings, ticker CHO. This is not your typical story of failure. It's a story of price action that has been, well, violently decoupled from its financial reality.
Violently is the right word, and the numbers defining this decoupling are just shocking. The company IPO'd at $4 back in September 2025. It then rocketed to an absurd peak of $21.91. But today, as of January 2nd, 2026, the stock has completely structurally collapsed. It's trading around 61 cents.
Wow.
Yeah, that represents a 96% drawdown in just a few months. And it's often on minimal daily volume. I mean, sometimes we're seeing less than $100,000 in daily trade value.
And now here is the paradox. While the market is priced CHOW for, certain death, the company's interim financial results tell a completely different story. They're showing an 81.3% year-over-year revenue increase, which is matched by an 80% surge in net income. That's delivering about 12.5 million Hong Kong dollars, or what is that, 1.6 million US?
Mm-hmm.
So the central question for any sophisticated investor looking at this space is stark. Which force truly determines CHOW's value? Is it the raw operational success and profitability we are seeing in the income statement?
Or is it the overwhelming, almost toxic market microstructure? I'm talking about the critically low float, the punishing short pressure, the historical shadow of the underwriters, and all the governance pitfalls. My position is that the fundamentals, while, yes, numerically appealing on the surface, are entirely irrelevant in the face of these systemic market risks. The current price is accurately discounting a very high probability of total capital destruction.
And my position is the exact opposite. I think the price collapse is an extreme, just an unjustified overreaction driven by technical factors. And because of that, it presents a deep, almost irrational value opportunity based on actual profitability. Look, I see why you think that the market microstructure is dominant. I do, especially given the history here, but let me give you a different perspective. This company is fundamentally profitable. That's a fact. It's profitable unlike many multi-billion-dollar giants in the same cloud computing space, like GDS Holdings and VNet Group, who are just persistently loss-making. If we take that $1.6 million in net income and we annualize it, even conservatively, and consider the drastically low current market cap of about $21 million, we're looking at an estimated price-to-earnings ratio potentially as low as 9.6 to maybe 14. For a hypergrowth company reporting an 81% revenue jump, that PE is incredibly attractive. I mean, if the market chooses to completely ignore healthy margins and 80% net income growth, it suggests a temporary, acute failure of the price discovery mechanism, a trap, not a permanent lack of inherent value.
I'm sorry, but I just don't buy that the growth translates to sustainable or reliable value, because the environment it's operating in is, well, it's poisonous. When we talk about fundamentals, we can't just look at the bottom line. We have to look at the fragility of that income. Even if those profits are 100% genuine, they're irrelevant because the external risks almost guarantee an unfavorable outcome. It makes the stock, in my view, uninvestable. The most telling signal of conviction from sophisticated participants, it isn't your PE ratio, it's the cost to borrow fee, the CTB, which has surged to an astounding 111.82%. Annualized. Forget the PE for a moment. When the cost of betting against the stock exceeds 100%, the market's risk assessment has moved far, far beyond simple earnings multiples and into a calculus of survival. It signals a certainty that the decline will be so rapid and so complete that the cost of borrowing is worth absorbing.
Okay, that brings us immediately to our first core point of disagreement then. The reliability and, I guess, the quality of that revenue growth itself. You call the income statement attractive, I'm hearing you call it questionable and lumpy.
Precisely. Let's dig into that 81.3% growth figure. The interim report reveals extreme customer concentration, which is a major, major red flag. Almost half, nearly 47%, which is about 83.5 million Hong Kong dollars, of that revenue came from just 3 new customers. And what were these contracts for? primarily one-off deliverables, things like cloud CDN services and server farm project implementations. In the cloud space, investors pay a premium for annual recurring revenue, ARR. They want stable, subscription-based income streams. This reported income is project-based. It's a lump of money tied to completing a few large server buildouts. This makes the foundation incredibly fragile. It's predicated on them securing another round of massive, potentially non-repeatable projects next quarter just to maintain that growth.
That's an interesting point. And I do acknowledge the concentration risk. It's genuine, but I would frame it differently from a strategic perspective. We need to look at what CHOW is actually selling. They are positioning themselves as a digital transformation consultant and managed IT services provider. They use these large initial consulting and project implementations, the lumpy revenue you're citing, as strategic entry points. Think of it as necessary groundwork. By completing a large server farm build-out, they establish the long-term stickiness required to transition those clients into their highly profitable recurring AI-powered cloud-managed services. The fact that they achieved $1.6 million in net profitability at all, in a sector that is so inherently capital-intensive, I mean, just look at the multi-billion-dollar losses that GDS and VNet perpetually rack up. That is a powerful counterpoint to your claim of fragility.
Value stickiness potential if the underlying structural risks are just too high. So let's move this to the mechanics of the market. Let's talk about interpreting those short side signals, because this is where the market is telling us the most important part of the story. You argue the 111% CTB is just a technical supply crunch. I argue it is fundamentally toxic.
And I maintain that the triple-digit CTB is overwhelmingly a function of the critically constrained, effective public float. I mean, estimates suggest fewer than 3 million shares are genuinely available for trading out of a total share count of over 30 million. The low float inherently restricts share availability. You can't sell what you can't locate and borrow. This scarcity drives up the borrow fee. It is a liquidity technology, not a pure organic reflection of bearish conviction on the company's long-term business. The fact that the reported short interest is laughably low, maybe 28,000 shares, is misleading. It's low precisely because the actual available supply has vanished. It's a classic liquidity trap that spikes the borrow rate without necessarily reflecting broad institutional belief that the company's going to zero.
That is a very dangerous way to interpret that 111% number. That high CTB is the truest measure of conviction, not the reported short interest, which is easily obscured by the inability to locate shares. Traders are willing to absorb a 100% plus annualized cost premium, meaning they lose money every single day the short position remains open because they anticipate a faster near total collapse, possibly down toward the reported tangible book value of what, 10 cents a share?
Right. So if they pay 111% to borrow, they expect the stock to drop, say, 50% in the next month. We also see evidence of institutional distribution happening off-exchange. Data tracking dark pools and non-exchange volume shows off-exchange short volume routinely exceeding 21% of total trading on high-volume days.
This signals sophisticated distribution is happening quietly, supporting the thesis that institutional players see this as a guaranteed short, regardless of the exorbitant cost.
But we can't ignore the shadow of the underwriters in this context. The whole life cycle of this stock, from that spike to the crash, is following a really disturbing pattern.
It is more than a shadow. It's a blueprint. We have to look at the historical precedent set by the U.S. Tiger Securities cohort, which CHOW is currently mirroring perfectly. Take Dark Iris or DKI. DKI IPO'd at $4, spiked dramatically on low flow, and then suffered a violent, predictable crash, eventually falling 92% down to 32 cents. CHOW is tracking that trajectory with eerie precision. Same IPO price, same spike, same critical collapse. This isn't just volatility. This suggests its entire life cycle is a characteristic event designed for quick volatility and decline by this specific tranche of issuers.
That historical parallel certainly heightens the perceived risk, but the market is always forward-looking. So what's the next catalyst driving this decline?
The most damning and predictable event, which the market is front-running right now, is the inevitable supply shock scheduled for March 2026, the lock expiry. Over 30 million insider shares held by founders, early investors, management, they all unlock in March. When you compare that 30 million share supply shock to the existing critically constrained public float of maybe 3 million shares, the potential for overwhelming dilution it's catastrophic. Even if insiders sell a tiny single-digit percentage of that total relative to the available public float, the supply increase would utterly destroy the bid price. The market is selling now because it knows that dilution, or at least the perpetual threat of it, is an unavoidable future reality.
I'm not convinced that the market hasn't already priced that inevitability in. I mean, I would frame this differently. How much more can you front-run a 96% drop? The stock is already trading like a distressed asset slated for bankruptcy. The market capitalization is only $21 million. We are talking about a company that is, as of right now, profitable. Furthermore, management does have defensive maneuvers available. Given their $1.6 million in net income and $1.5 million in cash, they could technically announce a small targeted share buyback, or they could issue an aggressive operational update that details their successful transition of those lumpy customers in recurring service contracts. I know they've been passive so far, but that option remains on the table for any management team that actually believes in its deep value proposition.
But their passivity is precisely why the microstructure risk dominates. Let's talk about governance and the existential delisting threat, because this is the layer of risk that turns mere volatility into total capital loss. This is a Cayman Islands holding company using a variable interest entity, a VIE structure, to operate in mainland China. That opaque VIE structure introduces what we call layer risk. It means the minority shareholders in the U.S.-listed entity have significantly limited recourse and transparency into the actual operational assets in China. The CEO holds dual authority as chairman and CEO. And what was management's official response when the stock collapsed 70% in December? They issued a boilerplate release saying they were, and I quote, unable to determine whether corrective actions are appropriate. That response, combined with the utter lack of insider buying at this drastically low 60-cent price point, is a severe negative signal. It suggests a management team that is detached from, or perhaps even complicit in the stock's volatility, certainly not one committed to defending the supposed value you identify.
You're focusing on behavior, but the technical risk of delisting is tangible, and it has to be addressed. CHOW is rapidly approaching the NASDAQ minimum bid price deficiency deadline. They have to maintain a $1 closing price for 10 consecutive days. Given the crash date, we're looking at a notice potentially arriving in late January 2026, which would trigger a mandatory path toward compliance. And if they fail to regain compliance, they will be forced into a reverse stock split, an RS. And while you might call that a technical adjustment, it's an existential threat to retail investors. Historically, reverse splits in microcaps are profoundly bearish. They often result in the stock instantly falling another 20 or 30%, which would frankly confirm your negative outlook. This mechanism is a technical risk, but it provides the gravitational pull toward your 10-cent book value target, completely regardless of the reported profit.
It was my initial thesis. In this toxic segment of the microcap market, the technical risks, the liquidity traps, the restrictive governance holes like the VIE structure, and the scheduled supply shocks, those are the true dominant fundamentals. They override any positive earnings news.
So to summarize the dilemma we've been exploring, I still maintain that the market microstructure issues, the critically low float, the triple-digit CTV, the lockup expiration risk, are undeniably severe and are the immediate drivers of the price. However, the underlying operational reality, that 80% surge in net income and the hyper-growth rates, suggests that if this company manages to navigate or just survive the current volatility, it presents an unprecedented value opportunity compared to its loss-making peers. The financial value is being held hostage by the mechanics.
And to reiterate my perspective, the constellation of systemic risks, the extreme customer concentration that makes the profit fragile, the governance opacity that limits shareholder protection, and that predictable pump and dump life cycle defined by this underwriter cohort, it renders the stock uninvestable regardless of the PE. The probability of the stock following the pattern of Dark Iris and collapsing toward its tangible book value of around 10 cents is simply too high to justify betting on a fundamental turnaround.
The CHIO case perfectly illustrates the difficulty of reconciling solid fundamental analysis with, well, toxic market mechanics in the microcap sector.
It demands that investors weigh operational success against the very real potential for total capital destruction due to these external systemic risks. There really is no middle ground when survival is on the line.
If you enjoyed this video, subscribe to the Stock Market Palantir channel for more stock reviews like this. Thanks for watching, and see you next video.